Good evening. Hope we're all well. It's Lewis here at Shore Financial Services, and for anyone that's viewing on this live stream, thank you very much for being here. Now, I was a bit unsure if I was going to do the live this evening. I had some bad news. I don't know if anyone's following me or you know me personally, but unfortunately, my dog Sam passed away in the early hours of the morning, so I do feel a bit jaded. But this has been scheduled now for coming up, I think, about a week, and I figured that in the event that someone had taken the time to watch this, I didn't want to let them down. So I don't feel necessarily my kind of same chirpy self. Nevertheless, I'm hoping that by doing this, it'll take my mind off it, and it might actually be useful. Who knows? Now, the first thing is, this is my first attempt at using proper streaming software on my own. I'm not the most technically savvy person going, so if there are any technical difficulties, I apologise, and I just hope that it all kind of goes okay. Now, why am I doing this at all? Basically, apparently this is how you have to do marketing these days. But also, there's quite a lack of information for people to go through the type of stuff I'm going to go through this evening, which is mortgage illustration, which is one of the key parts of when you're actually buying a home. It's something you're going to be presented with. And for most people, most of the time, first time you would see one is when you've had an offer accepted on a home, you're looking to make your mortgage application, and all of a sudden you get kind of bombarded with this document. And no one really prepares you for it. Most people aren't used to reading them. I mean, of course I am, all the mortgage brokers are. But as a consumer, chances are it's the first time you'll probably ever see one. And there's an awful lot of information. It's quite dense. It can be quite technical and laden with jargon. So I figured if I do this kind of stuff, then it might just help people feel a bit more comfortable with it. And also, perhaps when they're buying a home, no matter which mortgage broker they're talking to, at least they'll have a bit of an understanding of what they're looking at. So, without further ado, we'll get cracked on. Now, the first thing to say about a mortgage illustration is this. There's sometimes a bit of confusion when it comes to buying a home and getting a mortgage. And understandably, many customers kind of say, oh, you're going to send me a few options. Now, the financial conduct rules are very clear on this, that if you give someone more than one option, so this is not me saying it, these are financial regulatory rules. If you give people more than one option, it effectively becomes what's called execution only, where you're choosing rather than being advised. And that's not allowed, basically. And so when a mortgage broker presents a mortgage illustration, it's their recommendation. They're saying that based on the questions that you've answered and the information that we've got, and taking into account all your circumstances, this is the best option. So that's the reason why, if when you're buying a home and you ask a mortgage broker, can you send me a few options? Some may be reticent to do that. And if brokers are doing that, then you're kind of in a grey area, really, I suppose. But nevertheless, let's kind of get on with it. So what's contained in a mortgage illustration? Basically, it's everything about the mortgage. How much you're borrowing, how much it's going to cost you, the terms and conditions, repayment charges, obviously your monthly payments, of course, and any other bits that you need to be aware of. So hopefully, by the end of this, you'll be a bit more, as I say, a bit more comfortable kind of understanding them. Now, it's important to realise that when you're presented with this document, you can, of course, go back and ask questions, obviously. And no one should ever feel as though there's a question that they can't ask, because, more often than not, it's for multiple hundreds of thousands of pounds over the next 20, 30, in some cases 40 years. And it's really important that you're comfortable with what you're actually doing. So what I'm going to do is I'm going to go through an illustration that I've generated. It's attached, obviously I've done it in my own name. But before we get into that, I'm just going to say anything in this live stream, and then which becomes a video, doesn't constitute advice. This is for information purposes only, but I'm going to say this anyway. As a last resort, your home may be repossessed if you do not keep up with your payments on your mortgage. Now, I'm going to try and share my screen in a second just to show you what an illustration looks like, and then we're kind of going to go through it, kind of break it down step by step. It shouldn't take long, and then I'm going to get off and go and watch the last episode of Adolescence. So let's see if this works. Oh, I should say, actually, by the way, if there are any questions that you want to ask, then feel free to ask and I'll answer them as we go. Now, as I mentioned, I'm not the most technically savvy people, so if I don't see a question, I'm not ignoring you. I've probably just not clicked the right button and I can't see it, so apologies. Right, let's dive in. Now, if you're watching this on a mobile phone, which I suspect probably many people are, you may need to turn it on its side so that you can actually see it. Now, I'm not expecting you to read the wording in here. It can be quite difficult, but it should hopefully give you a good idea of what's going on. Now, why is it called an illustration? So the first thing is, and of course, I've titled this live stream Mortgage Quotes. Now, that's a bit of, it's just something that kind of grates, I think, on some mortgage brokers, but it's not a quote, it's an illustration. And it's kind of pedantic, I guess, but I might as well cover it off. And why is that? A quote is generally a person, it's a price that someone's going to do work for, you know, whereas an illustration is very much, if you're approved for this, this is what you'll get. Where a quote, of course, can change over time. Imagine you were getting a wall built and they said, oh, it's going to cost you, £1,000 to have a wall built. But when they started digging out, they find some pipes they've got to navigate and they may have to go down deeper. So what started out as £1,000 may turn into £2,000 because, there were unexpected complications where they started digging out to build this wall. Whereas an illustration is a regulated document, which means it has to follow set rules as set out by the Mortgage Credit Directive, which is a jargon. But what it's saying is this is what we're applying for, and assuming you pass everything, this is what you'll get. So it illustrates what's being potentially offered. Now, it's important to understand this isn't a mortgage offer. This is not to say you will get it. This is what you would be applying for. Now, the reason it's called an ESIS, if you can see that at the top of the sheet, that's because when the Mortgage Credit Directive came in, we all had to change from what were called key facts illustrations, KFIs, to ESISs, so that it was kind of standardised throughout the European Union. And even though we've left the EU now, we still have these rules in place. So let's get into it. Enough of me waffling on. Now, important to mention that they're only ever valid on the day that they're actually produced. And that's because mortgage rates can change in line with market volatility, etc. So if you remember back to the mini budget, when you heard a lot of stuff in the media about mortgage offers are being pulled, mortgage offers weren't being pulled because the mortgage offer is issued once you've been approved. And there were, politicians and the media were making the mistake of thinking that what was available was an offer, and it isn't. So that's why they're only valid on the day that they're produced. Now, I've produced it in my own name. All the lenders are available. I'm using Halifax. I have to select a lender in order to generate these documents. But of course, don't set any store by this. As I say, it's for information purposes only. And they all follow the same formula. So no matter whether it's me as a broker, Joe Blogs, or whoever it might be, they might look slightly, but they all follow the same actual formula of what's contained. So we'll get into it. The first couple of bits at the top are relatively straightforward. It tells you it's been produced today and who it's for. So obviously for me in this scenario. And then the first couple of bits at the top are, number one, who's the lender going to be and their contact details. And then number two, you have to also declare who you are as the credit intermediary, i.e. mortgage broker. And it contains, of course, your name, your contact details, etc. And importantly, it also displays the amount that a mortgage lender is going to pay to the mortgage broker on completion of the mortgage. That's our commission, so to speak. Technical jargon is it's called a procuration fee, but that's what we get paid. And it'll tell you as well if there's anyone else who's got their hand in the till at the same time, basically. So the first two bits are really straightforward. Who's the lender and who are you dealing with? And it's not until you move on to point 3 that you actually get into the main kind of chunks of the important stuff. And this will tell you about the main parts of the loan. So here you can see I based this on £1 million property and a £750,000 mortgage. But as I say, broadly speaking, they'll be similar. Of course, the numbers will be different. So the first part of the illustration is all about what you're borrowing, how much you're borrowing, what currency it's in, etc. And importantly, if there are any fees added to the loan. So in this scenario, I'm saying I'm borrowing £750,000. There's a 999 fee, and I've added that to the loan. It's over 25 years, so how long the loan is over, and the type of interest rate that you're going to get. In this scenario, it's fixed. Now, one part that always makes people panic is this figure here, total amount to be repaid, and it's always enormous. And that's when people start thinking, oh my God, mortgage lenders, they're absolutely hammering us, they're making all this money kind of hand over fist. That's not always the case necessarily. But let me just explain how that number's arrived at, because it's normally pretty big in comparison to what you're borrowing. So there are certain things that we know at the outset of the loan. In this scenario, we know that it's fixed and it's for 25 years. We know it's for £750,000. We also know that there's a fixed rate here that expires in June 2030, so it's 5 years, and it's at 4.25%. But we also know what the standard variable rate is, i.e. the rate that you would roll onto once your fixed rate expires if you did nothing about it. So that total amount to be repaid is the duration of the fixed rate period for 5 years plus 20 years at that higher standard variable rate inclusive of any fees. So that's why that number is always so large. Now, of course, most people are going to remortgage during the term of the mortgage. They're going to seek out new fixed rate deals or variable deals, whatever it may be, but you'll seek out new deals on more competitive interest rates. However, at the outset, we know that those are the facts. That's why that number always appears quite large. And the little bit below is about how much you'll pay back, but in easier terms to understand. So it's always how much you pay back for every pound you borrow. And then, of course, you've got the value of the property that it's going to be secured against. So in this scenario, I've said it's £1 million. Now, hopefully that part made sense. Now, point 4, this is always a bit confusing because in these documents, there's interest rates all over the place, numbers all over the place, and it can be quite confusing. As I say, it can be quite overwhelming when you're presented with this for the first time and expected to make a decision on the bounce. Now, APRC, annual percentage rate of charge, it's important to understand that this isn't an interest rate you'll ever actually pay. Not really. So it's an average rate. It's used for comparison purposes. If you think when you take out, for example, a personal loan, when you're searching online, maybe if you've gone on a comparison website and you're searching for a loan, you'll see the APR, and it allows you to compare loans against loans. So the lower the APR, the less interest you pay, the more competitive the deal. Happy days will apply for that. This is kind of a similar type of sketch for mortgages, except it's pretty much broadly useless, in my opinion. This is, of course, all my opinion based, so this, as I say, this doesn't constitute advice. So what the APRC is the cost of the loan expressed as an interest rate, taking account of the fixed rate period of what your fixed rate is, followed by the remainder of the mortgage on the standard variable rate, inclusive of any costs and fees, averaged over the term of the loan. Now, given that you're going to remortgage at some point during the loan, given that you probably move home, etc., that's why they're not particularly useful. But it's a kind of old hangover from regulatory, for whatever regulatory reasons they feel as though they're useful. It is actually just confusing for most people. So it's not an interest rate you'll pay. It's a comparison rate. It's not particularly useful to actually use to compare it to anything, but that's what it is. So if you see that figure, and you see 6.5 or whatever it may be, because of course that will vary depending on the loan and all those kind of variables, don't panic. It's a comparison rate. It's not an interest rate you'll pay. The bit below that is the interest rate you'll pay. And of course, this is the bit that most people are bothered about. So this scenario with Halifax, it's 4.25%. As I say, it tells you until when. And it will also tell you what the current standard variable rate is once that fixed rate expires, assuming nothing changes. Now, of course, we all know that mortgage rates and interest rates change over time, and therefore that's what the standard variable rate is right now. That's not to say that's what it'll be when you get there. So that's the APRC piece. And then you'll get into costs on a one-off basis. Now, when a mortgage broker is generating an illustration to recommend to you, they're taking into account lots of different things. Whether you wanted a mortgage with fees or without fees, whether you wanted a free valuation or not free valuation, cash back or not, etc. But any fees that are applicable will be contained in this part of the illustration, along with any mortgage broker fees that you've got to pay. So if it's not in here, then you should be questioning, if it later kind of transpires and someone goes, oh, by the way, there's a fee outstanding. If it wasn't in here, then you should be kind of raising that as a, well, why didn't you tell me about this before? Why wasn't it in the illustration? Again, most of these are pretty typical. You've got the brokerage fee that you pay to your broker. In our scenario, we charge 499 quid. And in this scenario, it's when the mortgage is offered. Now, the bit below, again, conveyancing fees. So this part here is not something you'll actually pay. This is the reason why some of this is kind of confusing. So the lender conveyancing fee isn't an additional cost. It's the money that you pay as part and parcel of your legal costs, so the fees that you've got arranged with your solicitors. And it's an assumption of the work that will be carried out by the solicitors on the lender's behalf. So that figure of £161.27, if you can see that, that's already accounted for within your legal fees in most cases. So it's not an additional cost, it's an assumption of the work the solicitors will do on behalf of the lender, because solicitors have to do various work on behalf of the lender. Check titles, check source of funds, etc., etc. Register the mortgage. That's what that is. Now, if there are any arrangement fees, this is the part where there'll be, you'll be able to see them as well. In this case, with this particular mortgage with Halifax at the moment, there's a 999 fee, and I, advising myself, have chosen to add this to the loan. And if there are any valuation costs, that's going to be highlighted too. So we've got the APRC, the comparison rate, any kind of fees that are applicable to the mortgage, they may need to pay upfront or as part and parcel of the application. And then you get to the bit at the bottom, which again is about this APRC. Now, that average cost of the loan, that interest rate that comparison rate rather, that you won't pay, we have to look over basically into the past and see how high interest rates have been. And because, of course, interest rates move over time, it could mean that the average cost of the loan increases. And that's what this bit is at the bottom, basically. So it's essentially saying that if interest rates rose to X, then the average cost of the loan could rise to Y. And it's in bold because it's a risk warning. Again, if you think back to kind of during the pandemic, when interest rates were super, super low, we assumed that they could never get to where they are, and of course higher than they had been. But of course, these kind of bold risk warnings are always contained in these documents, and it's something that can often kind of get overlooked, basically. So it's important to understand, if the proverbial really hit the fan, what would it actually mean? But don't get too hung up on it. Part 5 is just about how you're going to pay it. In this scenario, of course, it's always monthly anyway. And over how many months? 300 months, 25 years. Now, point 6 is the bit that actually matters. How much is it actually going to cost you? Pounds and pence, what does it mean? So point 6 is about how much you're going to pay. Now, if you're borrowing £750,000 currently, and you're buying a home for £1 million, then you'd be paying £4,068 and 45p a month, which is a hefty mortgage payment. But it details what you're going to be paying. But it also will tell you what happens after the end of the loan, when the fixed rate expires. And they'll give you that figure of the standard variable rate, assuming that that's the same. Now, it may not be, so that's an assumption. Now, in all mortgage illustrations, this line is dropped in. Your income may change. Please consider if you'll still be able to afford your mortgage if your income falls. That's basically a nod towards insurance. What happens to you if you can't earn money? Now, there are a few reasons why you might not be able to earn money. 1, you could have lost your job. 2, you could be unable to work due to illness or injury. Or 3, you could be dead. So it's a kind of nod towards insurance. It's a nice, gentle way of saying, what are you going to do if you can't pay this? And then again, we've got a bit in bold, which is talking about if that average cost of the loan rose, what could your payments look like? In this scenario, if it rose to a historic high, it could mean that SVR payment could go from just shy of 5.5k up to just shy of 8k a month. Now that can panic people, understandably, because who can kind of afford a doubling of their mortgage payments, which is what we saw, of course, coming out of the pandemic when people had these super low rates, and then we had the mini budget. That's exactly what happened for many, many people. But the get out of jail free card, of course, is that in most cases this will have been disclosed. Perhaps we're guilty of not paying as much attention to it as we maybe should, but it will be there. Point 7 relates to a table, ignore that. Now, obligations. So this is about what you're agreeing to with the mortgage. Basically, pay your payments, make sure it's insured. Don't knock it down and try and rebuild it, because you'll get into all manner of trouble. And of course, don't rent it out. This is a residential mortgage, I should say. Don't rent it out without first asking permission. But the full kind of terms and conditions are going to be within the mortgage offer when it's issued. So this is just a kind of high level what you should expect. So moving on to point 9, and I hope you're all kind of keeping up. I'm trying to get through this because, as I mentioned at the start, I do feel a bit jaded with what's happened. So I apologise if I'm whipping through this a bit quickly, but it will be recorded and you can go back and watch it if you really wish. So in every mortgage illustration, and certainly with the vast majority of fixed rate mortgages, there are penalties in the event that you want to pay the loan off in full during that fixed rate period. And it's ordinarily a percentage value of the loan. And in mortgage illustrations, they will always try to give you a cash figure in terms of what it could be, but also a percentage figure. And the reason is this. If you make overpayments on your mortgage, then your balance may be lower, but the percentage is still going to be the same. So in this scenario, in the first year of a 5-year fixed rate, it's a 5% penalty. But the mortgage, but it's assuming here that the mortgage balance, you're paying 5% at the point at which the mortgage is released. So with regards to these early repayment penalties, there are only a couple of times when you'd actually really trigger them. One is if you're clearing off the mortgage in full or you're exceeding the overpayment allowance. Or 2, if you're selling the house and moving to Dubai or Australia or whatever. Because in most cases, not all, most cases, most mortgages are what are called portable, and most have an ability to overpay. But the early repayment charges you should take notice of, because of course, in the event that you do need to move, or you do get a chunk of cash in, this is disclosed to you at the start, so you can make an informed decision about whether this is right for you or not. So you've got the early repayment charges. Generally, most lenders follow a similar kind of formula. They're not identical by any stretch. and depending on the type of deal and how long it's for, etc., it will vary. So pay attention to that, particularly if you do have plans to make huge overpayments, or if you're expecting a gigantic inheritance, or indeed, if you're really good at picking lottery numbers. But it will always tell you when those payments will be payable in terms of dates, when they change, and the cash amounts. And then we move on to point 10, which is all about any kind of features that are relevant to the mortgage that you may have asked for. In terms of features, we're talking about things like overpayment, portability, cashback, those kind of things, if there are any incentives. Now, what does portability mean? Basically, porting a mortgage is picking it up off one home and dropping it on another without triggering those overpayment penalties. So it gives you some flexibility to be able to move and get on with your life without kind of feeling hemmed in. However, not all lending policy is equal. Not every lender treats porting in the same way, which I know is frustrating for consumers because, of course, when you're talking to a broker, when you're thinking of doing this, most answers to most questions are, it depends, which is not particularly comforting, I get. But the reason is because that's the truth. For example, some lenders' porting policies that, assuming you're not borrowing any more, they don't really want to know what your income is, what your outgoings are, etc. They'll let you take it because they treat it as they've underwritten you at the start of the loan and therefore it's been signed off. If you want to move home, crack on, move home. Other lenders, with their porting policy, is much more stringent. For example, they might say, yes, you can port it, i.e. we'll not force you to pay these penalties, but we still want to check that you can afford the mortgage. We still want to check that you've got enough income coming in. We still want to check your credit profile, all those kind of things. So that's what portability is. So that's one of the reasons why, in many cases, you should be able to avoid paying those penalties if you needed to move during that fixed rate period. If, for example, there was any cash back with a mortgage. Now, what is cash back? Basically, it's a bit of an incentive that lenders just kind of tag on to the terms of the loan. So that when you move in, typically it's on first-time buyer mortgage products, but not exclusively. And it's a cash amount to say thank you, essentially. For when you've moved in, there's a bit of cash that comes back, a bit of a bonus. So if there was any kind of cash back, it would be detailed here. This particular mortgage doesn't have any. But if they were, it would be in this section. And it also talks about overpayments, which again, most people want to know about. So if you want to pay your mortgage off faster, you can make overpayments, and that brings down the balance of the mortgage, therefore less interest is generated. You pay the loan off faster, you save on interest payments. And that will detail, in this scenario, it says here it's 10%. That will detail how much you can overpay annually, typically, over and above your contractual mortgage payments without triggering any penalties. In the vast majority of cases, it's 10%, not always. Some don't allow any. Some allow up to 20%. In some particular types of mortgage, there is no overpayment penalty at all. You can pay it off in full. But that's what this kind of section is about. So we've gone through the penalties you may pay if you're fortunate enough to win the lottery and clear the mortgage. The flexibility of the mortgage. Can you move? Are you going to be trapped there, basically? And if you wanted to clear off the mortgage sooner, how can you do that? And then we get to point 11, other rights. Now, this part is generally worded quite poorly because it reads as though once you've taken out this mortgage and we've approved it, you're in. Basically, it's done. It's a done deal. And in 10 days' time, that's it. We're on. What it actually means is it's a chance for you to have a think about it. So let's assume you made your application, valuation has been carried out, everything's been approved, happy days. And like any contract, or particularly financial contract, there's a cooling off period where you get a chance to think about it and digest it and really come to kind of terms with what you're doing. And that's what this is. So even though it says after 10 days you've been given a binding mortgage offer, you need to reflect before committing yourself. That's the bit that freaks some people out, committing yourself to taking this loan out. What it's saying is essentially, if you don't say, I don't want this after 10 days, the mortgage lender basically just assumes you do. That's what it's saying. Now, it's important to understand that all the way up until you exchange contracts, you're not actually legally committed to anything. You would have spent some cash getting to that point. You may have paid a broker fee, you could have paid valuation and survey fees. Almost certainly you will have paid search fees to the conveyancers. But you can withdraw and you'll lose some cash. But you're not actually legally committed to anything. The point at which you are legally committed is when you exchange contracts, and that's when it becomes legally binding. That's when money's at risk. That's basically when you can't pay out, you can't pull out rather, without consequences. Okay, so when you see that kind of the 10 days before committing yourself, don't panic. That's what it means. Point 12, there's always a part about complaints because we're in a regulated industry, a very highly regulated industry, and therefore there has to be an option for you to complain. And any kind of complaints process will be detailed here, who you would contact, and it's normally the network or depending on who it is, etc., etc. But there'll be contact details there. And it will also talk about if they can't resolve it, you can go to the financial ombudsman, who's kind of like the judge and jury of financial services, basically. So there's always a defined complaints process as well. Now, the last couple of bits on here, they are relevant, otherwise they wouldn't be here. But they're basically telling you a little bit about the nature of the kind of legal structure to a certain extent. Number 13 about non-compliance, as I mentioned, don't rent it out without seeking permission, don't knock it down, because of course they're securing the money against the property. So if you knock it down, the security's vanished. And there's one line in here that, I always say word for word. I think most mortgage brokers probably do. But just above that, there's a part that most people should pay attention to. And it's about encountering difficulties if you struggle to make your monthly payments. Now, particularly through the cost of living crisis when mortgage rates went a bit haywire, lots of people found themselves in some hot water because there's only so much money coming in, and all of a sudden, if your mortgage payment doubles and your gas and electric have doubled, where do you cut the corners? But mortgage lenders aren't ogres, and they don't understand that things can go wrong. And they will always try and help you if they can. Now, they're not these kind of big fluffy teddies, of course they're not. But they're not after turfing people out, and they're not after just randomly repossessing people just for the sake of it, because it's a very expensive and difficult legal process, in fact. But if people do get into trouble, then of course always speak to your lender, because they will try and find a way around it. It might knack your credit file, but at least you don't lose your home, right? And the bit that you always have to say, or at least I always say, and I'm sure many do, is as a last resort, your home may be repossessed if you do not keep up with payments. Okay. And that's saying that ultimately, if you don't pay your mortgage, which I know you all will know, if you don't pay your mortgage, ultimately the long run consequence of that is you lose your home, you break your credit profile, and away you go. And then the last couple of bits is basically you're going to be provided with a draft credit agreement and who actually supervises. So supervises us. And of course, lenders are supervised by the FCA, as are mortgage brokers. And in most scenarios, and in most illustrations, right at the bottom, you'll get a repayment table, which shows you a cumulative, and our system systems work differently, but our system shows you a breakdown of the monthly payments and then cumulatively. But the important one is the one, I think, on the right-hand side, the remaining principal, i.e. that's the mortgage going down over time. So you can see at the outset what the mortgage balance will be, assuming you don't make any other payments, what the mortgage balance will be when that interest rate, that fixed rate rather, comes to an end. So we can see here that if I did take out a £750,000 loan, which I'm not about to do, if I did, by the time the interest rate was due to expire after 5 years, we can see that my mortgage balance would be about £657,000, a few pence, and a large panic attack. Now, this goes all the way down to zero, but you'll notice that it does change, and that's because, of course, we know that the interest rate is going to expire after 5 years, and it's going to revert to the standard variable rate. Now, we work on the basis of what that is at the moment, but of course, that can be different when you get there. but it will go all the way down to 0. So I know that that is a lot of me yapping, and if anyone has managed to get all the way through that, I really, really appreciate it. But basically, a mortgage illustration contains all the information that you need to be able to make an informed decision about whether that mortgage is right for you. So, who the lender is, what the interest rates are, the terms of the deal that you're getting, overpayments, monthly payments, that's the big one, of course. And hopefully that may have been useful because, as I say, for most people, most of the time, you probably haven't seen these kind of things before. And so at least now you're a little bit kind of, forewarned is forearmed, and you'll have a bit more, kind of a bit more experience. And admittedly, a small amount. I know that, after kind of 30 odd minutes on a live stream, that's not going to cut it. I get that. But at least you've kind of been walked through one. Now I'm going to jump into the chat. And Matt says he loves this. I don't know if is anyone else kind of making any comments. It doesn't look like there are. Or at least if there are, I can't see them. So I'm going to be on now for probably another 5 or so minutes. So if there are any questions and you wanted to ask me, then now is the time, or forever hold your peace. Or in fact, don't hold your peace, just, I would say get in touch. But then that counts as financial promotion, in which case I should tell you that I'm authorised and regulated by the Financial Conduct Authority, blah, blah, blah. So if there are any questions, now is the time. And it doesn't have to be about mortgage illustrations. It can be about when I say anything, mortgages and stuff, not about cars or, I don't know, certainly not about politics, because we'll all end up arguing and falling out probably. So if there are any, fire them in the live chat, and I shall do my best to answer them if I can. And if I can't, and if it's a question that does stump me, then I'll go away and find out the answer and let you know. Oh, actually, I hope the technical stuff has worked, by the way, because I'm not very good at this, and I do feel a bit uncomfortable doing it, if I'm honest. I don't know whether it makes me look like a geek, sad, or what. But here we are. So if there are any questions, as I say, just chuck them in the chat bit, and I'll answer them. And I'm just going to have a quick look on my phone to see if anyone's messaged me, to see if there are any questions on here. Well, there is one actually. Why can't I ask for more than one? Why can't I ask for more than one illustration? Right, so the reason, it's not that you can't ask for more than one illustration. It's not that you can't ask for options. It's that the part and parcel of advice is that we have to ask a lot of questions to give you the right advice. And the way that the way that kind of financial regulation works is that we take responsibility for what we're doing. So if you imagine it, if you imagine that I gave you 4 options and just went pick one, who's responsible for the choice there? It's you as the consumer. And the point of using a credit intermediary, which is the jargon for a broker, is that you receive advice, and that's where the kind of responsibility lies. So it's not that you can't have options, but it's more the point that if we're doing our jobs properly, that shouldn't necessarily be a question, because we'll have considered what types of deals and why, and fixing for how long and why, and how much deposit and why that particular lender, and what's the budget and those kind of things. So it's not, brokers aren't trying to be awkward. It's just that we're in a very highly regulated space, and we do have to follow those rules. But if you've done the job properly and you've kind of found out enough about your customer and about what's important to them and about their concerns, etc., then you should be able to make a recommendation. And assuming that all the conversations you've had have been in good faith and been open and honest, that shouldn't really happen. I mean, generally when I'm talking to customers, we'll look at different options, but when it comes to the actual recommendation in terms of, right, let's get this applied for, let's get cracking, we've already covered off that kind of stuff, so that's why, I guess. So someone asks, how difficult is it to get a loan at more than 4.5 LTI? So just to explain, LTI stands for loan to income, and loan to income sits in the background. So when people say, how much can you borrow on a mortgage? And people say 3 times your income, 4 times, 5 times your income. That's an LTI, a loan to income cap. And it's important to understand that the caps sit in the background as a maximum. That's not to say that that's what you'll get. If you've got 2 people, for example, on 25k apiece, so 50k household income, and the LTI cap is 5, you multiply 5 by 50 to get £250,000, and that would be the maximum you could borrow. But that makes a lot of assumptions, i.e. no debt, no children, all those kind of factors, the term of the loan, etc. Because, of course, mortgage lenders work on an affordability basis. This never gets explained particularly well. But if you imagine this, let's say that you've got £50,000 worth of household income. That might be affordable over 30 years, but whatever that monthly payment might be may not be affordable over 5 years because it'd be enormous. You're shortening the term dramatically. And that's where affordability comes in, because they have to work out what it costs to run a house and therefore how much they think you can borrow. What's the spare capacity in your budget to be able to make that mortgage payment? So how difficult is it to get a loan over 4.5 times your income as a cap, as a maximum? It varies on a few factors. So the amount of deposit, the bigger the deposit, generally, the higher the income multiples, although there's not much in it. There's a big change between 95% and 90%. And there are many lenders that offer enhanced income multiples. So it is doable. The vast majority of higher income multiples, kind of over 4.5 times, is predominantly aimed at first-time buyers because, like anything, it's the hardest step. And with house prices where they are and wages where they are, it can be very difficult. And therefore, many lenders offer enhanced income multiples or loan to income for first-time buyers. But there are lenders out there that will go, way beyond 4.5 times, assuming that you've got the income to support it, you're not saddled with tons and tons of debt that's crippling you. So it is doable, yes. Thanks for the question, by the way. Apparently there are 192 people watching, which I didn't expect, which is quite nice, I suppose. Let me just jump on here. Are there any other questions? Because if not, I'm going to jump off and go and watch a bit of TV. Probably having a little cry by my dog. Let's have a look on here. Let's see. How long does it take a mortgage application to go through? It's a fair question. So how long does it take from the point of applying for a mortgage until everything's approved? Again, unfortunately, the answer is it depends. The vast majority of lenders do publish service levels, i.e. they'll give you an average time frame from the point at which you apply to the point at which the mortgage is approved. Now, depending on how straightforward or not your particular application is, will determine where you sit in that average time frame. But all lenders have slightly different ways of working. But for the most part, your mortgage broker should be able to tell you the average time is X, and those average service levels are generally pretty accurate, to be fair. So that's that bit. Right, well, I don't think there's any more. I hope you found that useful. I'm going to kind of try and do a few more of these, simply because I keep being told by quite a few people that, trying to find this kind of information online can be quite difficult. Some of it can be quite contradictory as well. So these will become relatively regular. I'm not going to be doing them every night, obviously. I'd like to say I've got better things to do. I haven't in reality, but they will be, relatively regular. So if there are particular topics that anyone wants me to cover off, then just let me know. Just message me or DM me or at me on Insta or Facebook or Twitter or wherever, and I can jump on and do a live on it if you'd find that useful. But anyway, I shall say thank you for joining me. I appreciate it. And if you've not kind of liked, subscribed, I don't want to turn into one of those type of people, but if you could show it a bit of love, I'd appreciate that. And I shall say good night, God bless, and look after yourselves. See you later.